Hello, good afternoon. You're watching Closing Trades on ET now. Well, the market enthusiasm that we are seeing mid-trading session has fizzled out. We are in the red at the moment. From there, we have seen a bit of a recovery, but nonetheless in the red right now, just around the flat line. 24,200 has been given up. From the highs of the day, we are almost 200 points off. So there's a bit of a pressure building on the frontline index. The Bank Nifty is outperforming clearly today, 0.5% gain coming in on the Bank Nifty. That's of course led by HDFC Bank, which is up 0.8%. SBI is reacting to a good set of earnings, up 0.7%. And then IDFC First Bank is also up almost 2% in the trading session. From the frontline index, what's holding up quite smartly today is Power Grid. 4.5% up move coming in there. Remember, week gone by in the analyst meet, the company had talked about increased commissioning from here on. The capitalization targets were given, and that's the reason that stock is holding up with a gain of around 4.5%. Then IT as a pack is doing quite well. Infosys up, HCL Tech, TCS, they're all firing away in the trading session. So IT clearly the leading factor today in the trading session. Trent saw that initiation come back from Goldman Sachs. So that stock too, after getting badgered after the earnings in last week, is seeing a bit of a recovery right now. 4% up move for Trent at the moment. So clearly off the highest point of the trading session, Asha. But then there are these small spaces which are doing quite okay.
Yeah, they are. Biocon, especially ever since one of its Bangalore facilities got the VAI. PFC, after the recent upgrades that the stock has seen post its numbers, it's a good 7.25% move. Look at the intraday graph of Trent, or in fact pull out the last 1 week data on Trent, because it's seen a consistent selling, and finally post some upgrades coming in today, it's seeing some first signs of buying. There you go, almost knocked off about 8.5% in the last 7 days, and now you're seeing a good 4% of a bump up on Trent. Other than that, of course, the story is already just about earnings, and Asian Paints, that's the one which has really been taking a knock. Across parameters, you have seen pressure on the numbers. We are awaiting, of course, the management commentary as well post the con call. But Asian Paints hasn't seen any resurrection whatsoever. It's been gapped down and continues to see that kind of selling. About 8 to 9% roughly is the kind of cut that you're seeing on the stock through and through up until now in the trading session. Britannia, though, that's down about almost 6% in trade. So that stock definitely weighing heavy. But like we said, PFC, there's a Bernstein upgrade coming in. Target price 620 now, an outperform rating. And for CLSA as well, outperform rating with a target price of 610. That's the view coming in on PFC. But let's move on and let's try and understand what the market construct is looking like. What are the spaces which are also looking interesting in trade? We've got Naresh Mirani joining in on the show, and Sampath Reddy too is going to be joining us in just a short while from now. But Naresh, if I could first come to you, not the Nifty, but what are some of these stocks like, the entire IT pack, for instance, and Infosys, HCL Technologies, TCS? What's the Nifty IT telling you? And then, of course, names like Trent. Do you think this is a meaningful comeback and the selling is done with?
So the whole IT pack has started showing momentum after the US elections. We've seen good recovery across the board. So whatever little correction we got has been made a bottom, and we've started seeing good recovery. The leadership continues to be HCL Tech, just a few percentage points away from an all-time high. There is new breakouts happening here. So something like a Wipro, which has been sideways for a long time for the last 1 year, has now started crossing into 52-week highs. So we are seeing some leadership change as well as momentum coming in. So overall, IT still looks interesting. Would be focusing on names which are leaders or showing relative strength and starting up a move. So Wipro and HCL Tech, it would be. Trent, on the other hand, this could be more of a dead cat bounce, wherein so the stock started correcting post numbers. I doubt it would be able to cross that 7,000 mark, which was there on that day. So overall, this bounce back is a selling opportunity closer to 6,800 to 7,000 mark.
Okay, so that's a take coming in on IT. Yes, has seen a bit of a vigor since the US election outcome as well. But Sampath Reddy also joins us on the show right now. Of course, the founder and fund manager at Azurian Investment Managers. Hi, Sampath. Good to be speaking with you. Let's begin with IT itself, because yes, there is a sentiment uptick that we have seen since the US election. But do you think it will likely convert into earnings as well or not?
I think, at this moment, most of the analysts are of the opinion that with the tax cuts, expectation of the tax cuts by the new president, there is a possibility that, corporates might spend more on the IT side. I think that's what is leading to that optimism. But I'm not sure whether the way the commentary has been, where the earnings have come for the Q2 numbers. If you see, mostly the momentum is waning away. I think the growth rates are below the expectations for the Q2 gone by. I would not be at this juncture very optimistic about the way how it will pan out for the when the new president takes over. Probably we'll wait and see whether the order books or the new large orders are coming through the IT services companies. I think it's better to wait and watch than jump the gun and see how the order books will pan out for the IT companies.
Okay, let's see how it really pans out. For now, yes, that overall expectation that discretionary spend will go up and BFSI has bottom is definitely helping the street. But what about consumption, Sampath? And I'm talking about, the urban consumption bit, which was doing well earlier. But if you look at this quarter's earnings, whether it's QSR, whether it is paints companies, whether it is some of the durable names as well, it hasn't really lived up to expectations and earnings have managed to miss the estimates. What's your take on this?
Right. I think, overall this Q2 earnings which have gone by has been quite weak. I would say, most of the places there has been a sharp decline in earnings, especially even in the consumer side also the earnings growth has been disappointing, both on the volume front and even on the margin front as well. So that has been a sort of a disappointment for the, overall at the sector as such. Even if you look at the paints or, even if any other sector, if you see with the general consumer, QSR, most of the places the volume growth has been anemic and the price growth was also quite poor, and there has been a margin pressure as well. So because of that, overall the earnings have taken a beating, but these are the good companies and good sectors to stay invested even at this correction which we had seen in the last couple of weeks based on the poor earnings. I would still think the valuations are slightly on the higher side. One should maybe pick and choose few of the companies where they've corrected meaningfully, given the growth opportunities that the sector offers. Some of them could be from the QSR per se, given the stocks have correct, even though earnings outlook is very poor right now in the near term, the growth outlook for the longer term perspective is very, very strong. Some of these pockets where you can find the value and stay invested for the longer term perspective. But yes, the near term, the growth has been quite poor and disappointing in terms of numbers wise.
Autos, though the numbers have largely been in line for the second quarter, but the overall demand environment clearly looks to be growing a little bit slow. This was quite reflective in the management commentary, other than, of course, outliers like an M&M, wherein the tractor sales as well outperformed. The festive sales, it's picked up in the last 2 weeks, but it's really not, as great on a year-on-year basis right now. Majorly, it's largely on the back of higher discounts that most of these auto companies actually doled out. Wanted to understand, where is it, Sampath, that your preference lies within autos now?
Within the autos, especially the, both the two-wheelers as well as four-wheelers, we really like them. And, given that these are a relatively very high ROE companies, we've been liking them. And also there are, select pockets where, in the ancillary and auto ancillaries also there's value emerging. In spite of the relatively, poor volume outlook that we had seen in the last couple of months, I would think that especially the two-wheeler side, the opportunity is, quite good. And, some of the leading companies have already moved, rather made quite a good inroads into the EV side of the vehicles as well. So both the two-wheelers as well as, the four-wheeler, passenger car OEM makers and some of the, ancillary companies are also looking good from the valuation perspective.
Okay, some of these names are looking good from a valuation perspective, but just taking stock of what else is happening in the market, and what's buzzing is, of course, some of these lenders, the likes of PFC, REC as well. PFC came out with a good set of numbers. Even Power Grid, for that matter, post its earnings. Have been seeing that up move. Naresh, do you have a view on some of these power utility names which are perking up, in REC, for instance, PFC, Power Grid?
So the whole pack looks interesting. PFC, as a matter of fact, has given a breakout today after making a good base around that 440 to 430 mark. There were at least 3 to 4 bottoms around that area in the last 1.5 months. And the interim highs around 475 have been crossed today. So a clean breakout here. Also, the stock came back all the way to the prices where it was on June 4th. So a good correction also from the top of around 580. looks like setting up for a move towards 520 to 550 in the short term. Power Grid similarly went through a correction, slow drift, and has been sideways for the last 6 months roughly. Short-term breakout here, but would prefer a PFC REC in this pack as such.
Okay, well, let's take a very quick break on that note with news that we're still pretty quiet right now for the index. Heavyweights like Reliance, L&T, M&M, Bajaj Finance, all in the red as we speak right now. Even Tata Motors has given up most of its morning gains. But yes, on the flip side, you've got a bit of a tug of war with the IT pack on the one hand and names like HDFC Bank along with Maruti, which are also holding out quite okay, as is SBI. We'll take a break, continue tracking markets on the other side.
Welcome back. Well, there's commentary coming in from the Excite management at the bottom of your screen. For now, the stock is pretty much flat. We'll keep highlighting as and when we get important updates from that one. But we have got important updates from Biocon. That stock is sitting with a gain of around 8%. InfoEdge is the other one, which is higher by 4%. In fact, some of the other IT names from the broader markets, the likes of eClerx, etc., have been doing quite well. And then Zomato is in focus. Remember, they've started this food wastages or a special program to stop the food wastage, and that's why that stock is in focus as well at the highest point of the trading session. Sampath, have you looked at any of these so-called new age tech names, the likes of Zomato, Paytm, Nykaa, etc.? Any thoughts?
We're not really on top of these companies, but especially the businesses like Zomato, Swiggy, we like those businesses. It's just that the valuation are way high. I think that's where the major concern is. But and others like Nykaa and Paytm and some of these things, we're not sure whether how and when will the profitability will be meaningfully large. But these food delivery as such. I think there's a good, the business case. We also, as I said, we also like the QSR as a space, and also the food delivery as a, also as a new age from a new age basket, new age tech companies kind of basket. We like those segments.
I just wanted to highlight the number at the bottom of the screen. The SIP data is out for AMFI and it's coming at a whopping 25,000 odd crores in the month of October, when we're all talking about that volatility and the fact that the FI exodus really continues. It's DIIs which have held one end of the market, and that DI of course fueled by the SIP money. Aisha, 25,000 crores. I think first time we have hit that number.
Yeah, absolutely. For the first time ever, it's a record high. And what's surprising is, like you mentioned, at a time when, the FIs, yes, they were in complete exodus mode. There were a bunch of IPOs which were clearly all that, money guzzler, and they did suck a lot of liquidity as well. And I'm not only talking about Hyundai and Swiggy. They, of course, were a little bit lukewarm, but there were a bunch of mid-cap IPOs as well. So other than that itself, with that kind of high retail participation, with the kind of nifty correction alone that we've seen, the SIP participation continues to be that high, 25,000 crore rupees, and that really is a remarkable feat. The faith in the DI community, or retail participants, I should say, clearly continues there.
And
Any
the
more
other
data?
bit is, yes, the other bit is that the SMID schemes continue to see strong inflows. So yes, of course, large caps have seen increase in terms of the flows that they've gotten. But in fact, the large cap fund inflows have doubled to 3,450 crores. But the important bit is that money flows continue into the small cap and mid cap category still. So there's no big redemption happening of sorts from that vertical. Of course, if you look at the thematic or sectoral funds, there as well, we have seen a bit of a jump up. And of course, the equity flows continue to be at record high level. Focus funds have managed to do quite well. It's managed to surpass that 40,000 crore mark after 5 months. And of course, the SIP data up for you on the screen. We'll try and get an analysis going with either Sharad or get some experts to talk to us about this data, but nonetheless an important bit. Sampath, what's your take? Because it's clearly the DI money which is really supporting the markets, but can we really do without FIIs?
No, I think DI money has become quite large, and even overall, if you see the proportion of the ownership by the FIs have relatively come down. So the relative importance or the dominance of FIs have come down over a period of time substantially. And even if you see the the way the market is also today, the large caps are relatively more attractive, and while mid and small caps are generally still the valuation wise still on the higher end of the spectrum. I think that itself is also some sort of an indicator, how the flows are impacting the overall valuation as such. If you look at the FIS ownership broadly has been in the large cap oriented kind of companies, and with their selling, I think the overall relative valuations as such in the large cap segment are looking much better as compared to the mid and small cap. Generally speaking, the domestic institutions are a lot more bottom up in terms of investing style, and they do have a lot of exposure to the mid and small cap segment with a continuous positive inflows into the domestic institutions. Is also helping the valuations of mid and small cap companies still on the will be holding up. That's also sort of an indication why the mid and small cap still trading
True.
out is relatively expensive.
Oh, yeah, absolutely. Wouldn't beg to differ. But great having you on the show, Sampa. Thanks so much for taking the time out. And in fact, let me also bring on board Anthony Heredia as well and talk about these Amphi numbers that we're seeing right now. Anthony, hi, afternoon. Good to be speaking with you. Are you surprised the kind of bump up that we've seen? 25,000 crore rupees for the first time ever. And we were just discussing for all this, with all that FI outflows, with a bunch of IPOs and guzzlers at that, big ones, and the kind of market volatility and weakness as well.
No, so I'm not surprised, because I think, frankly, the way I see it, October is in some sense a tale of two halves. I think in the first half of October, as markets started to correct, we actually saw a lot of momentum in terms of flows, because I think there was enough amount of money on the sidelines. And to some degree, that momentum of flows, I think, has dropped a bit in the second half and probably in early November. But nothing to me suggests that retail investors are looking to redeem or take a re-look at their portfolios. I think from a domestic flow perspective, I think even with the drop in markets over the last month and a bit, I think sentiment is broadly intact. I wouldn't say it's the same as it was in August and September. It's dropped a bit, but I don't think it's dropped enough for flows to be a concern.
So the sentiment has taken a bit of a pause at the moment, of course, but not anything which is falling off the cliff, because that's very clear in the number as well, 25,000 crore SIP yet again. But Anthony, any sense as to whether the data is flowing more towards large cap, because it's doubled, it's coming in at a low base, but still has doubled, or any shift per se from, let's say, SMIDs to large caps?
No, and actually, curiously, as you've seen, large caps have actually underperformed the market in October, right? I think the reason for that is probably that's where the bulk of the FI outflow has happened. To me, if at all there's a clearer trend, it is the following. One is, I think there is a much larger preference for flexi cap and multi cap funds. Number two, in fact, that the data doesn't show on the outside, but one of the things that I am most encouraged is that this is the highest number ex NFOs, right? Typically in any other month, you had 35, 40,000 crore flows, of which 10 to 12,000 is NFOs. This month, NFOs have accounted for probably 3.5, 4,000 crores, and we still have a lump sum flow of over 40,000. So I think it's evenly distributed. I wouldn't believe that there's a trend shift towards large cap. I don't think there's a trend shift away from from small and mid. If at all I had to make a call, I would say flexi and multi-cap funds. And we're seeing a lot of interest. I don't think it shows in the numbers as yet. I think it will show in November. I think hybrid and multi-asset funds are also becoming a category which people are looking a lot more avidly at.
Okay, point taken. But help me understand this NFO bid that you were talking about. Of course, there were a lot of them a couple of months ago. The pace has slowed down. Is that something that you're also witnessing? And hence, of course, the flows will also get impacted, at least towards the NFO to that extent?
So I think it's a bit tactical and technical. Let me just explain. If markets are falling and I want to invest, my inclination is therefore to invest in an open-ended ongoing fund and put my money to work, right? Because an NFO obviously has a period of collection and then it gets deployed. So I think it's probably more to do with that. I mean, I know we did an NFO in the month of June, and with the election results, etc., there was a lot of volatility. We curiously saw more money come into our ongoing funds in the same week of our NFO. And the reason was pretty simple. If I'm looking to bottom fish or enter the markets because there's a decline, I'd much rather do it in a fund that's currently on and my money goes to work immediately. So I think that probably explains some of the NFO collections dropping. I don't think it's a reflection that people are taking a view that NFOs are not as good as they were in the past. I've anyways made the point multiple times over. I think the best route for an investor is stay diversified, buy an existing open-ended fund with track record, and buy NFOs only if they add some differentiation to the portfolio. Otherwise, stick to existing funds.
And it's interesting, Anthony, that we've seen the similar amount of interest for both SMID schemes as well as large cap funds. And I think it's very important to tell our viewers right now that you've got to have a diversified portfolio. Of course, if your risk appetite is really less, then go more for large cap schemes. But so the small cap schemes have actually given better return than large cap focused funds.
Yeah, and I think that, if you ask me, the reason is technical, because a lot of the FI selling that has happened in October most likely would have happened much more in the large cap stocks, right? So I think while valuations are probably in favor of large caps, just the sheer amount of selling volumes would have meant that large caps have underperformed small and mids in October. I don't think that's a trend that will hold, let's say, over the next 6 months or a year. But equally, I think, when you look at possible sector opportunities, stock opportunities, it's impossible to make a call that they're going to all come in large cap or they're all going to come in small or mid, which is why I think you're seeing a large amount of diversification of flows between these categories. And frankly, the category that you choose, if you can't make up your mind, is flexi and multicap.
Yeah, that's what happens. Thanks, Anthony, for making time and speaking with us. Another month gone by and another strong figure coming in as far as SIP is concerned, 25,000 crore and going strong. Anthony saying that there has been a bit of a slowdown in terms of the sentiment, not as strong as it was in the month of August and September, but nothing which is falling off the cliff, and that's clearly visible in the numbers. For the markets, if you look at the stock of UPL, that's under pressure. Remember, it will come out with earnings. So ahead of that, there's a 6% cut coming in on that one. Result reaction on Aarti Industries and, of course, Asian Paints. No buyers even at lower level. What's holding up okay is Biocon, further gain there. InfoEdge is another stock which is up around 4%. In fact, as we head into this very short break, here are the commentary coming in from the InfoEdge management. And get that commentary up for you, because what they talked about is the fact that overall the IT sector has bottomed out. From here on, they're expecting the momentum rally to continue. Non-IT hiring continues to be quite strong, and they're expecting break even when it comes to the Jeevan Sathi as well as the 99-acre business very soon. Here are what management had to tell us.
Even the IT companies are back to hiring once again. Most of them had overhired and had built up big benches, and utilization rates have fallen. Now, for most companies, they're back to pre-COVID levels. So, it's hard to predict what's going to happen in this world. It's a very volatile world, a very uncertain world. But hopefully, this momentum will continue. On the whole, it does look like GCCs are hiring once again. IT companies are hiring once again. Even startup activity is picking up. So net, we are bullish on IT hiring going forward. Well, 99 acres has been growing reasonably well for the last few quarters, and we've also managed to keep our costs under control. So on the one hand, we are growing the business at 15-18% year on year, and on the other hand, we've managed to keep our costs in check. And as a result, 99 acres at one point in time was losing about 30-35 crores a quarter 2 years ago, and it's fast, in my view, now sort of racing towards break even. Jeevan Sathi, we are again very, very happy with the performance of Jeevan Sathi. It was we changed the model 2 years ago, moved to a freemium model. Since then, we've changed our marketing strategy. We've deployed a lot more AI in the product than earlier, and we have started monetizing in a very smart way. So this year, in the first half, we've grown at about 34-35%, and our burn is almost down to sort of zero levels. The study abroad business, which is about 20% of the Shiksha business, has been hit. In fact, in the first half of this year, we saw negative 15% growth in that part of the business. It's a tiny business for us, but whatever we are seeing globally is perhaps having an impact.
Back with Closing trades right here in ET now. Was just looking at UPL's numbers, and it seems like it's a little bit of a miss. While we were not anticipating any blowout numbers from UPL any which way, but the revenues have seen an uptick of about 22.3% on a sequential basis, but the loss definitely had widened, and people were pretty hopeful of a turnaround when it came to the chemical space, led, of course, by UPL. We were penciling in a net profit, in fact, to the tune of about 92 odd crore rupees. And this has definitely managed to slip up quite a fair bit. If we can just get back to that loss figure. The consolidated EBITDA, that's seen an uptick of 22.8%. Now, I'm not sure if that loss figure was correct or not, because we were penciling in a profit of a good 92 odd crore rupees. So we will get more clarity on that. Don't go by the first flash. And what you're seeing perhaps is only a knee-jerk reaction on the stock price. The margins, though, are largely flattish, but we were expecting destocking trends in North America and Europe, which were anticipated to stabilize soon. The India business was also expected to show some amount of improvement. Pricing pressure and, of course, channel inventory levels are projected to return to normalcy right now, with exports also likely to perform well. So anticipating, maybe a decent set of numbers. But yeah, awaiting the management commentary, the guidance, and more importantly, the outlook going forward.
Yeah, but for now, it does look like it's an operational miss coming in from UPL, because the top line is better than expected. The other income is also in line. There's no big exceptional per se. Yes, the other expenses have shot up. That's one of the reasons for a big miss coming in on the bottom line front, because the other expenses have gone up to 2200 odd crores versus, of course, the figure of almost 2000 crore last year. And then finance cost has shot up quite materially. You have a finance cost figure of 1070 crores. That compares with 870 crore last year. And that, of course, they have said that there are some currency movements that they've tried to accommodate for, and there's a month-to-month adjustment which has happened there. But I think a 200 crore increase in other expense plus a 300 crore increase in the finance cost means that at the bottom line, you're looking at a number of 443 crore loss versus 189 crore last year. And even if you look at it on a sequential basis, the loss figure last quarter was 384 crore. Remember, the guidance given by the company stands at a revenue growth of around 4 to 8%, which I think they'll manage to do. It's about the debt reduction plan for UPL, which is important. So we'll track whether that happens or not. But for now, the stock is taking a bit of a knee-jerk reaction, because the bottom line figure is looking worse because of the other expense and the increase in the finance cost. But Naresh, what's your sense on the chart of UPL? Would you be a buyer at some level, maybe 500 bucks thereabouts?
So the stock had seen a decent recovery, but it's back below the previous swing lows, and this was the lows which were made back in August as well. Sustaining below 520 would actually make it much more weaker in that sense, and one would be better off waiting out for a dip all the way to 480 if it comes. 480 to 460 has been the low for the stock in 2024 as such, and also the price where it was back in 2021. So maybe around 480 odd levels, one could start looking at it again.
Details coming in for UPL. The net debt has actually increased by $627 million this quarter. I think that is something which the street will not like. The corresponding increase last year, of course, was much more. But they're talking about how contribution margins have been primarily impacted by overall pricing pressure in crop protection segment. The contribution margin this quarter has come down to 37.7%. That compares with 39.9% last year. And that's the reason EBITDA margin has also contracted to 14.2% versus 15.5%. They're also talking about SG&A spends being impacted by 16 million due to the ECLs and write-offs in Latin America. Seeds business has had a margin accretive growth this quarter, but strategic investments have been made there as well. The commentary coming in from Mr. Jay Shroff, the chairman and group CEO, suggests that the volume growth continues and they are on path to achieving a EBITDA and net guidance levels. So they are on track to achieve that guidance at least. But the fact that this quarter there has been an increase in net debt might not be taken that well. However, just to put it in context, the increase in net debt isn't as much as we had seen last year. We'll of course wait by for more details to come from the presentation as well, Aisha. But looks like it is a bit of a weakish set that we have at our hands. Though they are saying we continue to maintain an overall positive outlook for FY25 and expect accretive margins in the second half of the year. And the focus remains on cash generation and optimizing inventories. Let's see whether the street takes heart from some of these comments coming in or not.
Yeah, because the guidance for FY25 was about 4 to 8% revenue growth. I mean, as wide as that band may be, about 50-odd% EBITDA growth as well, $300 to $400 million of operational free cash generation, which they were looking to use for debt reduction as well. So that's UPL, and I think the market was going into the earnings as well extremely elevated in terms of the expectations, because this is supposed to be the poster boy for the particular sector. 8% lower now for UPL, 514 is where the stock is. But we're going to be addressing an ET Now exclusive, and it seems that there's good news now for India's green energy ambitions. Sources tell your channel that the centre is set to invite bids for 8,000 megawatt of projects in the rest of the fiscal. Let me take it across to my colleague Prakash Priyadarshi and get in more details on the same. Prakash?
Yes, we are given to understand that the government is likely to invite bids for 8,000 megawatt capacity of solar projects in the remaining months of the current financial year. A very significant development coming in, as sources are informing that this capacity will be in addition to the PM Surya Ghar Muft Bijli Yojana and Kusum Yojana. Along with that, these projects will be awarded in states such as Rajasthan, Gujarat, Tamil Nadu and Karnataka. As you are aware that the overall installed solar capacity has reached 90 gigawatt so far, and now government is planning to invite bids for additional capacity. Along with that, the government has already approved around 38 gigawatt of capacity under newly identified solar parks, which is very essential in order to achieve overall renewable energy capacity by 2030. Along with that, the government has set a target to achieve more than 50% renewable energy capacity by 2030, which is around 46.5% at this point of time. In addition to that, what we are also learning from our sources that the government will soon invite bids for 12,000 megawatt capacity of thermal power projects, which will be part of planned 80,000 megawatt of additional capacity. A very crucial development coming in, and that will be very important in the context of India's growing energy demand, which is expected to grow 8% and likely to cross 400 gigawatt in next 5 to 6 years.
Thanks so much for that, Prakash. The presentation is also out for UPL. Not much in terms of the commentary, but the two clear highlights is A, they're maintaining their guidance, and secondly, in most of the segments, they're talking about how the second half of the year is expected to be much better. For instance, they are saying that pricing pressure will be offset by lower input costs in second half of the year when it comes to the overall business. As far as the SAS business is concerned, they said there is a continuous focus on the stricter credit and inventory norms. For the Advanta business, they say that the continued business momentum is expected to yield a favorable results in H2. So that seems to be the commentary throughout, that the second half of the year is expected to be better, and they're on track to achieve that guidance. But Mayuresh Joshi also with us on the show. Mayuresh, any first thoughts on UPL or any other specialty chemical name that you like?
Afternoon, Anisha. No, I think numbers tad below par for UPL. Obviously, I think the description that you just mentioned, the Advanta business, the seeds business has done relatively better, but they are seeing pricing headwinds, specifically in the crop protection business. Now, within the geographies that they probably operate out of, you are seeing some scenarios where there have been instances of floods in a few European countries as well. And therefore, I think how does this revenue build up, specifically in the second half that they're maintaining their guidance, and specifically on the EBITDA front, is something to be watched out for. Obviously, I think the net debt has increased, not in proportion to what it was last year. But compared to the other agrochemical players, Anisha, I think the other agrochemical players who are more domestically focused have actually given a better set of numbers. Have a look as an instance for Paradeep Phosphates. They have given a good set of numbers, not just in terms of top line, but they're also expected to complete their entire backward integration as far as their entire sourcing is concerned. And therefore, as the phosphoric acid component also gets added in terms of the vertical integration that their plant will probably achieve, one can probably expect better numbers going forward with a very robust balance sheet as we speak. Also, in the case of Sumitomo Chemical India, as an example, I think very decent set of numbers. Top line increased quite substantially, almost 980 odd crores. EBITDA margin expansion was very, very profound, 24.8%, if I'm not mistaken, compared to 20 and 19 odd percent year on year, quarter on quarter. And the management seems very, very optimistic for the second half. With the monsoons we've seen and a good Rabi output season, that can probably be expected as well. So my take is that the EPS ratings for UPL probably look a little bit weak, as we see in markets with India. Their peers can probably do well, Paradeep, Sumitomo Chemical, as an example.
Okay, that's the take coming in right now on the specialty chemical space in particular. Haven't seen any resurrection irrespective of the guidance for UPL. The stock is still down and out. For the Nifty, of course, it's largely flat. But given that most of the earnings are behind us right now, Mayuresh, how is it that you've spotted your winners within the pack, and anything that you may have recommended to buy in the last 1 month in the market volatility?
Good afternoon, Aisha. I think banks did surprise us to a large extent because we were of the opinion that there might be some stickiness when it comes to banks, whether large caps or mid caps. Leaving aside a few of the banks, I think a large part of the banking universe has probably surprised on the positive. So Karur Vysya Bank as an example from the mid cap space, Bank of Baroda, is something that we continue liking, and as a disclaimer, holding in our global portfolios as well. Housing finance companies surprisingly have given good set of numbers as well. So PNB Housing, Canfin Homes, a large part of their overall component as far as their balance sheet construct is concerned is largely retail focused. And you've probably seen asset quality pressures actually come off quarter on quarter, year on year. Case in point being PNB Housing. In fact, NIMs have shown some element of stability for both these housing finance players as well. So as the interest rate cycle evolves, even in the Indian context, I think these NBFCs might actually benefit from earnings as we go into the next few quarters as well. From a domestic cyclicality point of view, as I just mentioned, I think a few of these agrochemical players had a decent show, and the expectation largely is that with better reservoir levels, expectations of a good Rabi harvest, the next few quarters might be equally good. Something on the watch list that we've probably kept, something like a Swaraj Engines. Again, the theme in terms of rural expected to do well, better than urban from what we're hearing from FMCG commentaries. Better MSPs that have probably been meted on better output might probably mean that tractor sales will improve, as we've been hearing from commentaries of M&M as well as Escorts. Swaraj Engines, I think, has given a very, very decent show as far as their part of the business is concerned. Year on year, quarter on quarter has been stellar. Margins have been stellar as well, and we expect this performance to continue. A little bit defensive as well, Aisha, to a certain extent, and therefore Syngene from the Pharma pack has given a good set of numbers as well. Our own sense is that their positioning within the CRO, CDMO space, expectations in terms of small molecules, biologics actually expected to do well, can actually augur well in terms of their overall business outlook as well. So a little bit skewed towards the domestic cyclicals.
Okay, point taken. You were talking about Syngene, so I wanted to check about Biocon as well. If you have a view there, the stock is doing very well, about 8% higher, getting that VAI status for the Bangalore facility. But what's the sense on the stock price from here on?
I think, Anisha, I think the response has primarily been because of the status approval that they probably got. But between the two, my own sense is that from a numbers consistency perspective, with the kind of client additions that Syngene has probably added over the last few years, and it's a very, very difficult business to get these Fortune 500 customers to your books and probably ensure stickiness stays with you, means that you have to do qualitative work, which they have been probably doing. The kind of scientists that are working on a lot of different CRO, CDMO projects actually also augurs well. And they've created a nice funnel in terms of the pipeline, both from a CRO, CMO, CDMO, biologics, big molecules, small molecules perspective. Biocon, to a certain extent, I think numbers are very, very patchy. One good quarter followed by two bad quarters, and therefore the consistency in numbers delivery still not coming through. I think this is a positive surprise that has come through. Let's see how the numbers stack up. But at this juncture, I think Syngene probably remains as a better player on our watch list compared to Biocon.
Okay, that's the take coming in right now on Biocon as well as Syngene. But clearly, this quarter has seen more hits, more misses rather than hits, especially, banks with microfinance and unsecured loan book exposure. They're the ones which have really taken it on the chin. Large private sector banks, of course, like the likes of HDFC Bank, Axis, have remained quite immune to the system. The biggest downgrades, of course, came by for a Manappuram Finance, for a Spandana Spurti, Credit Access Grameen. These were companies which within the MFI segment have seen quite a bit of pressure in the second quarter. Mayuresh, suffice to say that it's a big avoid right now for MFI?
Yes, and with the regulatory, I think, concerns still hovering around them, Aisha, I think there is always this fear that if there is some regulatory action that probably comes through, there might be some element of doubt on how these balance sheets might probably get, how they might probably evolve in terms of earnings if some restrictions are put in place. And therefore, I think within the space, as I said, a few of the housing finance companies have done well. We obviously at MarketSmith focus on leadership stocks. So within NBFCs in the broader universe, from a rural discretionary spending perspective as well, and playing the rural theme as well, Chola Investment and Finance can also be a good bet. Our own sense is that the kind of exposure that Chola probably has, the kind of pedigree that it carries via its parent, the capital adequacy that it probably carries in terms of its Tier 1 ratios, asset quality pressure is expected to come down as the rural economy actually improves. And as the efficiency starts coming through in terms of the collections, as we head into the next few quarters, that will reflect very, very positively in terms of asset quality pressures, A, coming off, B, provisioning, lesser provisioning probably required on the balance sheet as well, which might give an impetus in terms of the bottom line growth and improved ROAs and ROEs. So if you have to take a bet within the space and the broader NBFC universe, yes, microfinance, not at the juncture, but some qualitative stocks like Chola can be on.
Can't help but talk about Asian Paints, of course. Mayuresh, the day began with that gap down and it really hasn't gotten, bought into at all. The stock has struggled about 8 to 9% lower throughout today. What's the take now on the paints sector per se, and of course Asian Paints as well?
So for the sector as a whole, Aisha, I think a large component in terms of demand-led volume recovery has to come from both urban as well as semi-urban stroke rural areas. We've clearly seen that urban areas have been struggling in terms of consumption patterns. There is expectation and hope that there will be a revival in the second half as we speak. And therefore, with a lot of weddings expected to come around, you've probably seen the festive season kick off as well. And therefore, Q3, Q4 from a demand perspective should probably hold out for the sector as a whole. But two things which probably, again, offset these positive impacts that can come through. A, competition intensity is here to stay. And therefore, the kind of rebates that can still be there in the system for a large player like an Asian Paints as well can trickle down to the entire ecosystem. And therefore, I think competitive pressures across the paint universe, whether you're talking about distempers, enamels, entry-level paints, might actually continue. Second, I think input costs have shown some element of stability. But if there is some element of stickiness that still probably remains on this perspective, margins might still remain a little bit under the pump. And therefore, our take is that on the consumer discretionary side, much better place, paint sector might actually consolidate at this juncture.
Okay, that's Asian Paints in trade for you, still struggling, 8% lower. In fact, we spoke with an analyst as well, Kaustubh Pawaskar from Sharekhan. He expects near-term pressure on margins for Asian Paints to continue and adds that crude price movement, along with Birla Opus's market share, will be factors to look out for going forward as well for Asian Paints.
See, obviously, we have seen last 2 quarters have been weak for Asian Paints. Even we have seen in Q1 also there was decline in revenues and even the volume growth was below than what the expectation is. Q2 also was was quite disappointing for the Asian Paints. Now, it depends on how the demand environment is shaping up, especially in the festive months. We need to understand whether there is a pickup in the demand, and that will help us to understand how the volume growth momentum would be in the coming quarters. Obviously, competition is there in the market, and every large player will try to gain market share or to maintain market share. Birla Opus definitely is a new player. Will definitely try to gain share from some of the large players. So, it is still, we need to see how the performance would be in the quarters ahead. But in the near term, obviously, there would be pressure on the margins, considering the fact that there is a volatility in the crude prices. Also, companies would be spending on, promotional and, higher media spends, basically, to maintain their, shares in the market. So,
okay, that's the take coming in on Asian Paints. Still a struggle for that stock. But let's get in some BTST trades going. Naresh, what's it looking like? What stocks have you picked out for our viewers?
So first is the buy on REC. The stock gave a breakout, has pulled back a bit, giving a good entry point. Stop loss at 518, target price of 540. Second is the buy on Wipro. The stock is breaking onto new 52-week highs, finally showing some strength. A stop loss at 570, target price of 585.
Okay, that's the take coming in on some of those stocks which are looking good. Capital goods, of course, if you were to analyze the earnings so far, exports have remained weak because of, geopolitical tensions. So most of these, West Asian economies, with exposure to West Asian economies, some of these capital good companies have struggled a little bit. Having said that, Mayuresh, for L&T, does it continue to be a buy?
So we continue maintaining a hold rating on this, Aisha. Again, a large part of their order book is domestically driven. Their overseas order book largely driven by heavy engineering and hydrocarbons, primarily based out of the Middle East, which still seems to be going at a decent pace at this juncture. And therefore, I think the kind of construct that we probably got from the numbers, working capital days have come off. You've probably seen some element of improvement thereof as well. And expectations of the management in terms of how the margin performance will be across their business segments, including heavy engineering, including defense, including hydrocarbons. And therefore, I think orders should keep on continuing in a decent manner as far as the domestic order book is concerned. They will be executing at a decent pace as well. And therefore, I think within the capital goods universe, as a proxy to different segments of the markets that L&T has exposure to, and some high growth elements and segments as well, this is one stock that if you continue holding in your portfolio, you should continue.
What about Reliance, though? It's lost about almost over 4 lakh crore rupees in the market cap since the peak in July, Mayuresh. I mean, what's been ailing the stock?
So actually, again, if you look at the business segments, right, if you look at the retail-oriented businesses, specifically Jio and Reliance Retail, I think these businesses will continue doing well. We're heading into the festive season, so the next 2 quarters for Reliance Retail should be relatively better. Obviously, the kind of stores that they've opened in the past few months, as the utilization levels picks up and as fixed cost absorption starts taking place into the system, I think the relative performance should be better. For Jio, again, you've seen and heard that the subscriber base has come off. They're losing customers to BSNL, but I think it's those low subscriber customers that are probably going off, and therefore the ARPU that has gone up should show consistency for the remainder of the qualitative customers that they probably got, and therefore Jio should have a steady showing going forward. What really gets offset, Aisha, is their upstream business and the petchem business itself. With crude prices under the pump, the expectations of Singapore GRMs remaining a tad bit under pressure would probably mean the upstream business might face some element of headwinds as we head into the next few quarters. Even though they have optionalities in terms of feedstock, that can still create some element of risk in terms of the compounding of earnings for this segment. China recovery still doubtful at this juncture, and therefore the petchem business, the spreads that we've probably seen and the deltas that the petchem business operates out of, the end product prices still seem to be very, very soft. And therefore, even this leg of the business segment that Reliance operates out of can be a little bit soft, which offsets the kind of stability that the retail businesses offer. Obviously, hydrocarbons, biogas, the new energy businesses, some while away. Long-term story, very, very positive. Short-term headwinds probably offsetting tailwinds at this juncture, and therefore the price correction.
Okay, Mayuresh, we'll let you go on that note. Naresh, thanks as always as well. Let me hand it over to Snehi to wind up how the closing trades have been.
Absolutely. If you take a look at what today's trading session was like, and the first half of the day, it seemed rather optimistic because Nifty was gaining, but nonetheless, Nifty is ending the note on a weak footing, 23 points lower, but very lower under the 24,200, much below that mark that we had actually managed to scale in today's trade. 24,125 thereabouts is where the Nifty is right now. If you take a look at that, let's also pull up Sensex, because Sensex is also roughly 600 points lower from the day's highest point, under that 79,500 mark also as of now. And Nifty Bank, however, is one space that has done well in today's trade, 1/10%, 1.1% rather, pardon me, higher, but it has simmered down slightly, and 0.5% gain coming in for Nifty Bank also over there. If you take a look at what's done well and what's not done well on the street today, Power Grid, Trent, Infosys, HCL Tech, Tech Mahindra, your Nifty gainers in trade. However, the ones that were weighing on the index today, Asian Paints 8% lower on the back of weak numbers coming in. Britannia was down 5.7%. We'll have the numbers out shortly as well. Apollo Hospitals, weak set of numbers in poor commentary also coming in from the management, 3.6% lower. Cipla, ONGC, Bajaj Finance, Tata Steel, all of these stocks have weighed on the index
today. If you take a look at the sectoral gainers and losers, IT continues to do well, 1.2% higher is where IT was. Nifty Bank, Financial Services and PSU Bank. So the financial pack has done pretty well for itself today along with IT. However, what did not do well today was Nifty Media, Metal, Pharma, FMCG, Energy, Auto and Nifty Realty. All of these sectors have ended the day in the red today. Quickly highlighting couple gainers and movers. Your Advanced Enzyme that was down 11.8%. Aarti Industries weak earnings, stock was down 8%. ITI, PFC, Alembic Pharma, Biocon, InfoEdge, all of these stocks were outperformers in today's trade. But largely, well, yes, that's how we're wrapping up today's day. 24,123 on the Nifty. That's what's reflecting on the charts. But well, yes, nonetheless, it's a finish in the red for our markets today.